Hey everyone, welcome back to The Explainer. In the last one, you learned the five-phase sector rotation map. Today we're getting highly tactical. We're going to look at the actual instruments you use to trade a sector call, and we'll walk through a real-world rotation you could have ridden over the last couple of years.
Okay, let's dive right into this. As a quick recap, you already know the map, the 5 phases of the market cycle and their 5 sector leaders. But here's the thing. Jumping into the exact right sector at the exact wrong phase, that is still a losing trade. You really don't want to buy a late bull sector, like energy, during an early bull market. You'll just bleed time while tech does all the heavy lifting, purely because you were early, not necessarily wrong. So to execute these moves perfectly, we need the exact right instruments.
Section 1. The Arsenal. Investment Vehicles.
First up, we have to identify the absolute core enemy of the macro investor, and that's individual company risk. This is the very real danger of losing your capital just because one single company underperforms. Maybe they have a terrible earnings report or, a massive CEO failure. And this can happen even if the broader sector they belong to is absolutely thriving. Seriously, the last thing you want is to get the big macroeconomic trend 100% right, only to lose your shirt because one executive made a mistake.
So how do we fix that? We use vehicles that isolate your true macro call from individual company execution. On one side, you have the sector ETF. That's just one ticker symbol representing an entire sector, which completely eliminates individual company risk. On the other side, you've got basket trading. This means buying the top 3 to 4 stocks in a single sector instead of just betting on one. It targets a slightly higher upside while still cushioning you against a single stock disaster. If one company in your basket stumbles on bad news, the other 3 are there to absorb the blow. Just to put some familiar names to this concept, here's some common broad market tracking ETFs you're going to see pretty much every day. QQQ tracks the NASDAQ 100, SPY tracks the S&P 500, and DIA tracks the Dow Jones Industrial Average. Basically, these vehicles let you trade the broad market or an entire sector exactly like you would trade a single stock. But again, you are completely sidestepping that individual company risk we just talked about.
Section 2. The Proof of Concept. The 2020 to 2022 relay race.
So the crucial point to remember here is that sector rotation is exactly like a relay race. Capital is the baton, and it gets passed from sector to sector in a highly predictable order. Your job as a macro investor? It's knowing which runner is about to take the baton next, not staring at the runner who is currently leading. You have to anticipate that baton pass well before it hits the mainstream headlines.
Let's actually map this directly onto our recent history to prove this isn't just some academic theory. Coming right out of the 2020 pandemic recovery, tech and consumer discretionary led the initial bounce. That is classic early bull behavior. Then, moving into 2021, reopening spending really accelerated, so industrials and capital goods gained relative strength. Bam! Middle bull. By 2022, as inflation surged across the board, energy became the absolute standout leader. Textbook late bull. That is the entire rotation map playing out in real time, literally in a compressed 2-year window.
And this brilliantly illustrates the point. In 2022, this massive divergence became glaringly obvious. The broad S&P index was actually negative. The growth-heavy tech sector, it sold off hard, plunging highly negative. But the energy sector was highly positive. It vastly outperformed the broader index because it acted as a late bull inflation hedge. If you used an ETF to capture that energy sector move, you nailed the macro call and you didn't have to lose a minute of sleep worrying about which specific oil company was performing the best.
Section 3. The Challenge. Test your knowledge.
All right, let's put you in the driver's seat. Here's your scenario. You're analyzing the data, and you believe the late bull phase is starting. Inflation is climbing, commodities are surging. What do? Do you buy one single energy stock, or do you buy an energy sector ETF, or maybe a 3-stock basket? I'll give you a second to lock in your answer. The answer, of course, is the ETF or the basket. Remember, if you buy just one single energy stock, you are carrying company risk right on top of your sector call. You are trying to express a macro sector view here, not place a bet on one single company's execution. These vehicles exist precisely to isolate the call you are actually making.
Section 4. Summary and the handoff.
Let's move on and see how all this builds together. Before this explainer, you knew the 5-phase map. Now, you also know the vehicles for expressing a sector call. It all builds into a highly repeatable process. Step 1. Determine the active cycle phase using your macroeconomic data. Step 2. Identify the corresponding strong sector for that specific phase. And Step 3. Choose between a sector ETF or a basket of top names, based entirely on how much individual company risk you're willing to carry. That is the logical progression, and you can now execute this entirely on your own.
Now I want to leave you with this final thought. Sector rotation is the engine of the market, but interest rates, they are the fuel. Next time, we're going to cover the single chart that tells you more about where rates are headed than almost anything else, the yield curve and the inverse law of bonds. It is the one chart that tells you exactly how fast that engine is about to run. You absolutely won't want to miss it.